We've got news out of Bloomberg that hedge funds are betting big against President Biden's Inflation Reduction Act companies and already making millions of dollars. Renewable energy has become a political flashpoint. So I want to dig deeper into this news, the stocks, and how to invest. I usually stay away from this kind of political news and would rather keep it out of the comments. But for this one, feel free to go crazy, go as political as you like. I'm not picking a side here. I'm just going to talk about money. Before that, if you want to keep up with all the stock market news and trends, I want to personally invite you to get the weekly bow tie, our weekly newsletter before the market opens each week. I'll give you the stocks to watch, the economic data to guide the markets, and the stock market news you need to know. It's all totally free, just something I like to do for all you out there in the community. So look for the sign up link in the description below. President Biden did sign the Inflation Reduction Act, the IRA, over a year ago, directing new government spending to programs that will somehow reduce inflation. Honestly, there are some good things coming out of this act. I think because inflation was just such a big boogeyman last year, though, they found a way to increase government spending and make it sound like a good thing just by putting the Inflation Reduction Act on it as a title. The IRA directs federal spending to projects reducing carbon emissions, lowering healthcare costs, and funding the IRS. Just over $250 billion of that 400 billion total is going to energy through tax incentives, grants, loan guarantees for renewable energy products. Within that, we see $216 billion in tax incentives just for companies alone. Rebates, tax write offs. We have another $43 billion in consumer tax programs and $82 billion in grants. For consumers, these are going to be things like that $2,000 tax credit for if you buy an energy efficient appliance. There's going to be that $4,000 per vehicle tax credit for buying an electric vehicle. But as with all government programs, costs have a way of spiraling out of control. And research by Goldman Sachs believes this could actually end up channeling as much as $3.3 trillion into renewable technologies over the next decade. And unintended consequences have already come along to piss on Biden's parade. The IRA and renewable energy have become a political issue ahead of the 2024 election because, of course, they would. Everything has to become a political issue nowadays. This is why we can't have good things, folks, because politicians want to make everything political and just turn us against each other. Like here in my adopted state of Florida, Governor DeSantis is blocking IRA money, including $5 million in rebate programs for people buying those energy efficient appliances, $24 million for roads, and $3 million to fight pollution. In all this, the hedge funds smell blood in the water and are lining up to short the stocks of renewable energy companies. Vivek Ramaswamy's anti-ESG funds have hit $1 billion in assets, which is very rare for new funds like these to ramp up so quickly with investor dollars. The 11 ETFs are backed by some other big name investors like Peter Thiel and Bill Ackman for that anti-activist, anti-ESG role. But that political story isn't why most hedge funds are lining up against these IRA companies like solar and renewable energies. Shares of SunPower Corporation, ticker SPR, are down 76% over the last year. Sunrun, ticker RUN, is down 60%, and short interest in all these stocks has surged. Shorted shares in Sunrun have increased 10 million shares to 20% of float over the last year, and SunPower shorts have almost doubled to 30% of the stock's float. But again, the hedge funds shorting these stocks aren't doing it from some political bent. Bloomberg interviewed hedge fund investors from Plato Investment to Anaconda Invest, and they're all saying the same thing, the same three things beating these stocks down: higher inflation, higher interest rates, and a weaker consumer. We'll start with inflation. David Allen, head of the long short strategies at Plato Investment, calls it the Inflation Acceleration Act, in part because if you artificially boost the demand for these companies so suddenly, these solar energy companies, it's one, going to cause just supply chain issues that are going to drive prices up higher for those companies. But two, that the companies themselves are going to raise their prices for consumers ahead of that demand. That's something we've already started seeing when Dutch solar company Ørsted announced its earnings, warning of a $2.3 billion hit because of supply chain issues, those higher costs, also higher interest rates. Those higher interest rates, as the Fed increased interest rates in the fastest pace in 40 years last year, interest rates are also hitting this renewables group first in that cost of business. Okay, these companies are highly leveraged, dependent on the easy debt financing over the past few years. And since most of them aren't profitable yet, so they're seeing a huge jump in just the interest expense to finance that debt as well as to refinance any of it. Those higher rates are also meaning a lower present value of cash flows for the stocks. Okay, when investors analyze these shares, you bringing those stock prices down lower from the peaks that we saw in 2020. Higher interest rates means a lower present value of future cash flows. Most of the stock value of these stocks, these renewable energy, these solar companies, Most of that stock value is locked up in future cash flows. Those future cash flows we're all hoping are coming, but are now discounted at higher interest rates and worth less on a net present value. So that the higher interest rates are a big factor in bringing the stocks down. Topping it all off is the consumer, clearly weakening as we see the jobs market slow from last week's jobs report and the return of student loan payments. Consumers are naturally just going to think twice about spending thousands of dollars on solar upgrades, even if they get some of these incentives, but going into debt for thousands of dollars for their home on these upgrades. So all this is coming together to weigh on those solar energy, those renewable stocks. Hedge funds are lining up against them, selling their shares short. Interest rates, inflation weighing them down. A weakening consumer isn't helping out anything. The fact is, folks, the world is moving towards this renewable energy. So we could eventually see these companies bounce back strong. I want to show you how to look at them, how to find some of the best to invest in and that will survive long enough to see that growth return and produce the higher returns. Here we are on Sunrun, ticker RUN. I'm going to use Enphase, Sunrun, and SunPower as examples here. You can use these for any solar energy, any stocks, really. We're going to be looking at three things. We're going to be looking at the expected growth in sales and earnings, so that growth in the stock, in the fundamentals. Then we're going to be looking at the balance sheet health that can survive and the valuations of these stocks, all putting these together to decide which stocks you go with for that long-term growth. Here we are on the analysis tab on Yahoo Finance, shows us the current year and next year estimates or expectations for sales and earnings. Crucial to see these growth stocks continue to book those earnings, even if the environment is negative right now. If they can keep that growth stock theme, then they can grow into their valuations and produce those higher returns. Here we see for the current year for Sunrun 2023 are expecting $2.35 billion in sales, $2.58 billion in sales next year. Now, that would only be 1.2% higher for sales this year versus last. 9.7% growth next year does look better. This does not look like a growth stock. Okay, why are they only growing sales by 1.2%? Even in a tough environment, a growth stock should be growing sales by at least 5, 10% or more. We see here in the earnings expectations an unprofitable company. Okay, loss estimates of 98 cents a share for this year. Loss of 98 cents will improve marginally next year, but still 82 cents loss per share. We can compare that against the estimates for SunPower Corporation, ticker SPWR. We see here $1.82 billion in expected sales for this year, 2023. That's a great gain of 6%, gain of 5.7% sales next year to 1.92 billion. Again, that does not impress me as far as sales growth. We would have to look further out to see if they can increase sales growth any faster than that. We do see though that it is expected to return to profitability next year. It booked 33 cents a share last year, 33 cents a share profit last year, expected to lose 12 cents a share this year on those higher costs, supply chain issues that we've heard about, but then it is expected to post 23 cents a share profit next year. So that is a positive for the stock. SunPower versus something like a Sunrun, they are expected to return to profitability by next year. Here with Enphase, we see Enphase with $2.66 billion in this year's expected sales. That is a 14% sales year-over-year sales growth for the company. Expected 17% sales growth next year to 3.12 billion. So this stock very much still a growth stock. Very much management is still able to grow those sales year over year by double digits against its competitors, registering just 1%, 5% sales growth per year. We also see for Enphase expected to post $5.08 per share earnings this year. Profitable company growing to $6.61 per share in earnings next year. So not only a faster sales growth, but also a profitable high earnings per share for this company. Now looking at that balance sheet health and the valuation, here we are on the statistics tab. We're back on Sunrun, ticker RUN. We scroll down here, we can see the market cap and enterprise value. Now the difference here between the market cap, the valuation of shares, or the value of all the shares in the market, $3.28 billion for Sunrun there, and the enterprise value of 12.6 billion. The difference there is the amount of cash and debt it has on the balance sheet. I'm going to show you how that works out. Remember, we have a market cap of about $3.3 billion. If we scroll down to the balance sheet, we can see that Sunrun has $669 million in balance sheet cash and $10 billion in debt. Okay, so if we take that total debt, $10 billion minus the $669 million in cash, that's about $9.3 billion in total debt. We add that to the market cap, $3.3 billion, and we get that enterprise value. So the enterprise value, very much a debt inclusive way to value a company. Very important to look at that for these highly leveraged companies like these renewable, like these solar energy companies, looking at the debt as well. Now, if we go back here, if we were to look at that $669 million, it should be able to finance its operations with that, but that debt is going to become something of an albatross around its neck, really weighing the company down, especially with these higher interest rates. So we do see $12.6 billion enterprise value. If we look here at valuations, we can look at an enterprise value to revenue. So that enterprise value to its sales, 5.21 times. That is quite a bit below where it was trading at last year. It traded for an average right around 21 times. Enterprise value to revenue, obviously very much discounted right now. Price to sales, 1.3, 1.4 times price to sales. Again, a discount. But what we have to consider is this growth stock going to grow into these valuations? Is it going to grow with that 1% sales growth this year? 17 or 9% sales growth next year, I think I remember. Is it going to grow and return the valuations to that? Okay. When it was trading for 2.4, 3 times price to sales, when it was trading for 21 times enterprise to revenue, it's because investors were expecting those double-digit growth rates in sales. If they're not expecting that kind of fast growth rate in sales from this company anymore, they're not going to drive those valuations up higher. They're going to keep it here at 5 times enterprise value to sales or at 1.4 times price to sales. And you're just not going to see the rebound or the return in this stock. Here we see a slightly different picture here with SunPower. We do see $1.17 billion in market cap, $1.46 billion in enterprise value. So the enterprise value slightly higher here. We do see a very much stronger balance sheet for SunPower, $114 million in cash and just $403 million in total debt. So about $300 million net debt here. Very much stronger financial position for shares of SunPower. They do not have that overhanging debt that is probably going to weigh on something like a Sunrun. We look here at the valuations. We do see a 0.8 times enterprise value to revenue. That is much lower. Price to sales, 0.6 times price to sales for shares of SunPower. Much better buy, much better investment than shares of Sunrun there, just on these valuations and on this balance sheet health. It is a similar picture, if not a little bit higher valuation for Enphase Energy, ticker ENPH here. We do see market cap and enterprise value fairly similar. Actually, enterprise value is lower than market cap. That means they have net cash balance sheet. We look here, $1.8 billion in in total cash on the balance sheet against $1.32 billion in debt. So they have more cash than debt on their balance sheet. That is a very healthy sign. They're going to have the financial flexibility to survive through this period and really survive into that rebound in the future. So about $500 million in net cash balance sheet. That is going to help Enphase survive and grow, and even take advantage of some of the struggles of their smaller competitors here. We do see valuation is quite a bit higher though for shares of Enphase versus its peers. 6.4 times on a price to sales, 5.8 times on an enterprise value to revenue. Obviously, it does have that sales growth that is giving it a stronger valuation. Again, investors are looking at that stronger double-digit sales growth and they're saying, "Hey, I'm willing to pay more for shares of Enphase. If it's going to be growing at 15, 16, 17% sales growth each year, I'm going to pay more because it's going to grow into these valuations." We can see that it was trading at almost 10 times more than that on an enterprise value to sales ratio just last year. 5.82 right now, upwards of 50, 60 times on a price to sales or enterprise value to sales ratio. Price to sales as well, 6.4 times right now, 22 times, so about 3 times more just over the last year. So as you do this kind of analysis, looking for which solar companies, which renewable energy companies are going to be able to survive through this tough economic period, the higher interest rates, the higher inflation, the weakening consumer, which are going to be able to survive and grow into the future as we move towards that renewable energy future. These are the things you want to look at. You want to look at first the sales growth, earnings growth. Is the sales growth growing at a growth stock speed? Okay, are they growing at that double-digit sales growth that would be in that growth stock theme? And would justify some of these high valuations. Okay, these valuations are very high for growth stocks, and they need to be growing those sales at that commensurate pace. You also want to look at profitability. Are they a profitable company like Enphase, where it's already a positive sales or positive earnings per share? Or is it like SunPower, which is expected to grow into that profitability next year? Or like Sunrun, where it could be several years before they are profitable and they're still booking those losses per share. That's the growth, that's the sales, that's the earnings. Then you move on to the balance sheet. Do they have the balance sheet health and lower debt to survive through the next couple of years? With Sunrun, we see that very high debt already, higher interest expense on those higher interest rates. Are they going to be able to grow, or are they going to be able to survive over the next couple of years as they try to get to that earnings profitability? Again, Sunrun, several years out from earnings profitability, they're going to have to issue more debt, maybe issue more shares, and dilute shareholders to be able to survive through this tough economic period. Not so for SunPower. They're expected to return to profitability next year. Cash flow, free cash flow growth is positive there. Enphase as well, already profitable. So you want to look at the balance sheet, whether they have lower debt to survive through this period. You want to look at valuations. Valuations, not necessarily a bad thing if a stock has a higher valuation, is high price to sales or enterprise value to sales ratio, because that's what investors see. Investors see those double digit sales growth. They see a strong company that is going to survive, and they're going to bid up the shares higher than the competitors. That's fine if that company can continue that sales growth, continue that pace, and really survive and rebound in those shares. Look for that link below and get the weekly bow tie free every week before the market opens. All the stock market trends, stocks to watch, and economic news you need to see. Or click on the video to the right for the new Tesla ETF that could win whether Tesla shares go up or down. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.